Welcome. Today, we're going to talk about how an average family can start investing their money to secure a stronger financial future. Have you ever wondered how you can make your money work for you? Investing is one of the most effective ways to grow your savings and ensure your family's economic stability. In this video, we're going to explore three basic types of investments: stocks, bonds, and mutual funds. We'll discuss what they are, how they work, and how you can start investing in them. You don't need to be a financial expert to begin investing. With a little knowledge and planning, any family can do it. Let's start with an overview of what investing is and why it's important. Investing is the process of putting your money into assets or financial instruments with the expectation of gaining profits or income in the future. Unlike saving money in a bank account, where growth is slow due to low interest, investing can offer much higher returns. Throughout this video, we'll provide practical tips and current examples to help you better understand how these investments can benefit your family. Let's get started. Now that we've introduced the concept of investing, let's dive into stocks. Stocks represent a share in the ownership of a company. When you buy stocks in a company, you become a shareholder and own a portion of that company. Stocks can be a very profitable investment, but they also come with risks. Stock values can go up or down, depending on the company's performance and market conditions. However, over the long term, stocks tend to offer higher returns compared to other types of investments. Imagine a company as a cake. Buying stocks is like buying a slice of that cake. If the company succeeds and grows, the value of your slice also grows. Additionally, some companies pay dividends to their shareholders, which means you receive a portion of the company's profits in cash. Investing in stocks doesn't mean you have to be a financial genius. There are many tools and resources available to help you choose the right stocks. Plus, you can invest in mutual funds or ETFs, exchange-traded funds, that diversify your investment across many different companies, reducing risk. Choosing the right stocks to invest in may seem like a daunting task, but it doesn't have to be. Here are some tips to help you make informed decisions. First, research the company. What products or services does it offer? Does it have a good reputation and a solid track record? Read financial reports and news related to the company to understand its current situation and future prospects. Second, diversify your portfolio. Don't put all your eggs in one basket. Investing in different sectors and companies can reduce risk. If one company is not doing well, others can offset those losses. Third, consider your time horizon. Are you investing for short, medium, or long-term goals? Stocks tend to be more volatile in the short term, but can offer greater returns in the long term. Fourth, keep dividends in mind. Some companies pay dividends regularly, which can provide additional income on top of stock value growth. Finally, don't invest more than you can afford to lose. The stock market can be unpredictable, and it's important that your financial situation isn't compromised if things don't go as planned. Remember, investing in stocks is a marathon, not a sprint. Patience and discipline are key to long-term success. Let's move on to bonds, another popular investment option. A bond is essentially a loan you give to a company or the government. In return, you receive periodic interest payments, and at the end of the bond term, you get your original investment amount back. Bonds are considered safer investments compared to stocks, but generally offer lower returns. They are an excellent option for those looking for a more stable, lower-risk investment. Imagine the government needs money to build a road. It issues bonds that citizens can buy. In return, the government commits to pay interest on these bonds over a specific period and return the money at the end of the term. There are several types of bonds, including government bonds, municipal bonds, and corporate bonds. Each has its own characteristics and levels of risk. For example, government bonds are typically safer, while corporate bonds may offer higher returns but come with higher risk. Bonds can be an excellent way to diversify your investment portfolio and reduce overall risk. Choosing the right bonds for your family investment portfolio can be simple if you know what to look for. Here are some tips to help you make informed decisions. First, consider the bond issuer's credit rating. Credit rating agencies like Moody's and Standard & Poor's assess the issuer's solvency and assign ratings that indicate the level of risk. Bonds with higher ratings are generally safer. Second, analyze the bond yield. The yield is the interest rate you'll receive on your investment. Bonds with higher yields may look attractive, but they generally come with higher risks. Third, consider the bond's term. Short-term bonds mature in less than 5 years, while long-term bonds may have maturities of 10 years or more. Long-term bonds tend to offer higher returns, but are more sensitive to interest rate fluctuations. Fourth, diversify your bond investment. Like stocks, diversifying among different types of bonds can reduce risk. You can invest in a mix of government, municipal, and corporate bonds. Finally, consider taxes. Some bonds, like municipal bonds, may be exempt from federal taxes and, in some cases, state and local taxes. This can make them more attractive in terms of net yield. Now let's talk about investment funds, a powerful and accessible tool for any family looking to invest. Investment funds pool money from many investors to buy a diversified portfolio of stocks, bonds, or other assets. There are different types of investment funds, including mutual funds and ETFs, exchange-traded funds. Mutual funds are actively managed by professionals who choose the assets to invest in, while ETFs typically track a specific index and are traded on stock exchanges like shares. One of the biggest advantages of investment funds is diversification. By investing in a fund, your money is spread across many different assets, which reduces the risk of significant losses. Additionally, investment funds are managed by professionals, so you don't need to be an expert to benefit from them. Another advantage is accessibility. You can start investing in funds with a relatively small amount of money, making them ideal for families who want to start investing but don't have large sums available. Investment funds also offer liquidity. You can buy and sell shares in mutual funds at the end of each trading day, while ETFs can be bought and sold throughout the day on the market. Choosing the right investment funds for your family requires a bit of research, but the benefits can be significant. Here are some tips to help you in the process. First, define your investment goals. Are you investing for your children's education, retirement, or a short-term goal? Different investment funds have different risk and return profiles, so it's important to choose those that align with your goals. Second, research the fund's history. Look at the fund's past performance, though remember that past performance does not guarantee future results. Also, review the credentials and experience of the fund manager. Third, consider the fees. Investment funds can have various types of fees, such as management fees and buying and selling fees. These fees can impact your returns, so it's important to understand them before investing. Fourth, diversify. Don't put all your money into one fund. Investing in a variety of funds that include different types of assets can help reduce risk. Finally, regularly review your investments. The market and your goals may change, so it's important to review and adjust your investment portfolio periodically. Diversification is a key principle in investing that can help reduce risk and improve your chances of earning good returns. The idea behind diversification is not to put all your eggs in one basket. By investing in a variety of assets, you can protect your portfolio from significant losses if one of those assets doesn't perform well. Imagine you have a portfolio made up of stocks, bonds, and investment funds. If the stock market goes down, bonds and investment funds can help offset the losses. This way, your overall portfolio can remain more stable. Diversifying doesn't just mean investing in different types of assets, but also in different sectors and geographies. For example, you could invest in stocks of technology, healthcare, and consumer companies, as well as bonds from different governments and corporations. You may also consider investing in international markets to take advantage of global growth opportunities. An investment fund is an excellent tool for diversification since it automatically invests your money in a wide variety of assets. However, you can also diversify within your portfolio of funds by choosing funds that focus on different sectors and regions. Diversification doesn't eliminate risk entirely, but it can help you manage and reduce the impact of market volatility. One of the most common myths about investing is that you need a lot of money to get started. The truth is, you can begin investing with small amounts and still benefit from the growth of your investments over time. First, set a budget. Determine how much you can allocate to investments each month after covering essential expenses and saving for emergencies. Even small amounts can add up over time thanks to compound interest. There are many online investment platforms that allow you to start with small amounts. Some services even offer the option to automatically invest a portion of your paycheck into a diversified portfolio. This can help you develop the habit of investing regularly without too much thought. Consider systematic investment plans, SIPs, that allow you to invest a fixed amount regularly in mutual funds. This not only makes investing easier, but also helps you take advantage of market fluctuations by buying more units when prices are low and fewer when they are high. Remember, the key to successful investing is patience and consistency. Don't be discouraged by short-term market fluctuations. Keep your long-term goals in mind and continue investing regularly. Monitoring and adjusting your investments is an essential part of managing your portfolio. As your financial goals and market conditions change, it's important to review and, if needed, adjust your investments to ensure you stay on track. First, set a schedule for reviewing your investments. This could be quarterly, semi-annually, or annually, depending on your needs and the types of investments you hold. During these reviews, evaluate the performance of your investments against your goals. If you find that some investments aren't performing as expected, investigate why. It might be a good idea to consult a financial advisor for a second opinion. Sometimes a downturn is temporary, but in other cases, it may be necessary to sell that investment and explore other options. Also, as you get closer to your financial goals, you may want to adjust your risk level. For example, if you're saving for your children's education and they're nearing college age, it might be wise to move some investments into safer options like bonds. Remember the importance of diversification as well. As you adjust your portfolio, make sure to maintain a variety of investments to minimize risk. Finally, stay calm and avoid reacting impulsively to market fluctuations. Investing is a long-term game, and staying disciplined can help you reach your financial goals. To wrap up, let's see how these basic investment concepts can be applied in a family's everyday life. For example, let's say a family is saving for their children's college education. They could start by investing in a diversified mutual fund that includes both stocks and bonds. As college approaches, they might transfer a portion of their investments to safer bonds to protect against market volatility. Another example could be a young couple wanting to buy a home in the future. They could open an investment account and make regular contributions to a low-cost index fund. Over time, their investments can grow, providing the necessary capital for a down payment on their new home. For those nearing retirement, diversifying their savings across different types of assets, such as fixed income and equity funds, can help them maintain a steady income source during their retirement years. It's important to remember that investing isn't just for the wealthy. Anyone can start investing with small amounts and, with patience and discipline, watch their savings grow over time. The key is to educate yourself, set clear goals, and follow a long-term investment plan. We hope you found this guide on basic investments for a family helpful. Don't forget to subscribe to our channel, like this video, and share it with your friends and family. See you in the next video.